Okay, so we're now going to go over, this is going to be our last class. And this is going to be a culmination of everything that we've learned through this entire semester. And what we're going to be talking about today are how using different financial instruments can create similar economic results. But because we're using different financial instruments, we're going to end up with different tax results. And anytime that you hear that you can do something using similar, getting similar economic results and different tax results, then by definition, there has to be tax planning. Or there could be a tax trap that you want to avoid. But if I can do the same thing 2 or 3 different ways and end up with 2 or 3 different tax consequences for doing the same economic transaction, then by definition, that has to give you tax planning opportunities. So let's get into the PowerPoint. Let me share the screen. And we'll start the presentation. And the first thing we're going to talk about, and it's going to be probably the most important thing that I've taught and gone over this entire semester, is put call parity. So this has nothing to do with taxes. This is all about economics. But if you understand put call parity, you'll understand many of the things that we spoke about during the semester. And that's why we talked about it the first day of class. And also, it now will open up, now that you know all the tax rules, and you come back to applying put call parity, you could see how you can create a lot of tax planning opportunities. That put call parity, remember, said that if we buy a call and sell a put with identical strike prices and identical expiration days, economically, we have the same interest as though we own the underlying property that's underlying the options. So if it's an option on stock, it's as though we own that stock. If it's an option on gold, it's as though we own the gold. If it's an option on a treasury note, it's as though we own the treasury note. So now you know that we have a choice. We can either buy the underlying property directly and get the tax results that flow through to the underlying property, or we could synthetically own the property by buying a call and selling a put. And now we're going to have the tax rules that apply to options apply. And those are going to be very different tax rules. So let's just make sure, again, let's go over this and make sure that it really works. So in the example that I use, I'm using a stock called Xilinx, and the symbol was XLNX. If any of you are going to try to do and replicate this example, and you're going to look up Xilinx, you're not going to find it. Xilinx has been merged into another company, American Micro Devices, AMD, and so Xilinx no longer exists. I left this example because I did the example, it worked, and I didn't want to recreate it. I did the example in December of 2021, and I used an expiration date of January 20th, 2023 on the options. It was a little over 1 year. Xilinx paid no dividend, was not expected to do so, so this thing will work. When you do, it'll work with dividend paying stocks too, but it's more complicated because you have to take the dividend into account in coming up with the prices. So the easiest way to do this for yourself at first is to use a non-dividend paying stock and just prove to yourself that this really works. When you want to get more complicated, use a dividend paying stock, and you've got to factor the dividend in and coming up the way this will make economic sense. And so what I did was I pretended that I bought 100 shares of Xilinx, and back then it was trading at $198.50. And so my out-of-pocket cost for 100 shares would have been $19,850. I assumed that I could borrow at 1% for the 13-month period, and it would have cost me $200 in interest expense. So my total cost through the purchase until January 20th, 2023 would have been $20,050. And I compared that to buying a call with a January 20th, 23 expiration date with a $200 call, and I would have sold the put with a $200 strike price as well. And my net cost for buying the call and selling the put would have been $50. I would have spent 41.75 on the call, I would have taken in 41.25 on the put. And then I said, okay, now let's assume that Xilinx is trading at $225 a share on January 20th, 2023. How much is it worth? And it's worth $22,500. So my profit would be $2,450. Now let's go over to the option side. Assume Xilinx is at 225 on 1/20/23. Again, it's worth $22,500. But we don't have a position in Xilinx. We have a position in the call and the put. The call is now worth $2,500, right? Xilinx is at 225. The strike price is at 200. That call is worth $25. It's now worth 100 shares. 120 is worth $2,500. But we bought it for 41.75. It's only worth 2,500. We actually have a loss of 16.75 on the call. However, the put is worthless. No one's going to put the stock to us at 200 if they could sell it in the marketplace for 225. We sold the put. We took in 41.25. That's our profit. So our profit on the option transaction is $2,450. So our profit on the option transaction equals our profit on the stock transaction. And you might be thinking, well, that worked on the way up. What happens on the way down? So again, we're out $20,050 by buying the stock and incurring the interest expense. Our total cost for the options was $50. And now I assume that Xilinx is down to 175. Well, Xilinx is worth $17,500 and we invested $20,050. We lost $2,550. On the, sorry about that, on the call and the put, the call is now worthless. We're not going to exercise the call and buy Xilinx at $200 under our call when we could just buy it in the marketplace for 175. So we lost our entire call proceeds. We lost $4,175. The put that we sold is now worth $25 because someone could put it to us for 200 and it's only selling for 175 in the marketplace. So the put is worth $2,500. However, we sold it for 41.25, which means we made a profit on the put of 16.25. And when you look at the overall transaction, we lost $2,550 on the options. We would have lost $2,550 on the stock. They're the same. They're identical. These are the same transactions economically. And that is key. So buying the call, selling the put is the same thing as buying the underlying property. And as I said, this works no matter what the underlying property is. It could be 100 ounces of gold. It could be barrels of oil. It could be a treasury note, or it could be shares of stock. If you're doing options, these rules apply universally. And now we go to the next page where I do simple algebra. And I don't know, some of you might say there's no such thing as simple algebra, but unfortunately, we're going to have to use algebra. Our long positions are positive, our short positions are negative. So we just proved this one, call minus put equals stock. Well, if I multiply both sides by -1, I then end up with put minus call, long put, short call equals short stock. If I go back to my first equation and I add a put to both sides, what do I come up with? Call equals stock plus put. And if you go through an example, you'll see that it works out. If I subtract the call from both sides, we end up with a negative put. A short put equals stock and a short call, referred to as a covered call. And that's what we spoke about when we were doing the straddle class. So someone who sells short a put is doing the same thing as someone who buys stock and writes a covered call against it. And once you start seeing all these things, you can see how you end up with different tax consequences depending on which side of the equation you're on. But you're doing equal transactions. So anytime that we can do equal transactions and end up with different tax results, a tax person should get excited about that. So hopefully I'm exciting some of you, and you might want to get more interested in working with financial instruments after taking this course and seeing this last class. So now let's go into some examples of how we can now use this to practical use. So the first thing we can do is we can buy all the stocks in the S&P 500 on leverage, or we can leverage the purchase of an S&P 500 mutual fund or an S&P 500 exchange traded fund. Either way, we're buying the physical asset and we're getting exposure to the S&P 500. And so what are the tax rules? Because we own these assets, if we sell these assets at a gain, our holding period is going to determine the tax rate. Either we're going to have long-term gain or short-term gain. If it's long-term, it's 20%. If it's short-term, it's 37%. And our holding period determines the tax rate. Because we own the stocks or we own the ETF or the mutual fund, we're going to receive dividend income. And that dividend income is going to be taxed at a beneficial rate. Now, because we're buying this on leverage, we're going to incur interest expense. This is going to be investment interest expense. Investment interest expense is only deductible to the extent we have investment income. To the extent that we're getting dividend income that's qualified income from this transaction, that's not going to be deemed to be investment income. So in order to deduct this investment interest expense, you're going to need investment income from someplace else. However, if you don't have any, then you can make an election to treat part of your dividend income as non-qualified, and you do that so that you can deduct your interest expense. Same thing when you sell these things at a gain. If you have long-term capital gains, that's not investment income either. So again, you can elect to treat a portion of your long-term capital gain as short-term capital gain, and then you'll be able to deduct your interest expense against it. So again, these are going to become tax considerations that you're going to have to take into account if you decide you want to buy the stocks themselves. Now, remember, if you buy all 500 stocks, some are going to have gains, some are going to have losses. They're not straddles, and you could start picking off the losses. You can start recognizing the losses to create short-term capital losses, offset them against capital gains that you have from other transactions. And by using the techniques that we learned in the wash sale section, you could replace those stocks and not disallow the loss and never get out of them economically. So there's a lot of tax planning that can be done, tax considerations to be taken into account when you buy all the stocks. And again, if you don't want to make these elections and you have excess interest expense, you could just carry forward the interest expense and it goes on forever. Now, what else can we do? We could buy a call and simultaneously sell a put with identical strike prices and expiration dates on an S&P 500 mutual fund. We're going right back to put call parity now. And so now when we own the call and sell a put on an S&P 500 mutual fund, it's as though we economically own the S&P 500 mutual fund, which means we economically own the S&P 500. An S&P 500 mutual fund is a corporation. So we're going to have options on a corporation. Those options are covered under Section 1234. And under Section 1234, our nature and the gain or loss on the call is going to be determined by the holding period. Why? Because we own the call. So if we own a call and the holding period is more than 1 year, we get long-term gain. If it's less than 1 year, we get short-term gain. Any gain or loss on the put, though, is going to be short-term. And why is that? We've sold the put. Holding period is irrelevant. Now, if the mutual fund goes way up in price, the majority of our gain is going to be on the call. And so the gain, the majority of the gain should be long-term. If it moves up very slightly, we might actually have a loss on the call and a gain on the put. So you've got to watch that. But again, we're getting very different tax results than if we own the S&P 500 outright. Again, because we're using 1234 options, we wait until the options expire or until we sell the options before we recognize any gains or losses. Nothing happens during the life of the transaction. So if we bought a 2-year option at year end, we don't do anything. Now, if the S&P 500 goes up and we want to exercise the call, so now we're going to own the S&P 500 mutual fund. We're going to get the mutual fund. It'll be treated as a purchase. It's not a taxable event. And we now will own the S&P 500 mutual fund. And remember, the holding period of the S&P 500 mutual fund will begin on the date of exercise. Now, we're buying options. We're dealing with options. We're buying an option, we're selling a put. There's no dividend income that we're receiving. There's no interest expense that we're paying. None of that happens from a tax viewpoint. However, the dividends and interest will be priced into the options. So economically, we're earning the dividend income. Economically, we're incurring the interest expense, but for tax purposes, they don't exist. So that's a major difference between buying a call and selling a put on an S&P 500 mutual fund, as opposed to buying the 500 stocks in the index or buying the mutual fund itself. All right, so those are some differences. Now, the next thing we could do is we could buy a listed call and simultaneously sell a listed put with identical strike prices and expiration dates. But instead of doing it on a fund, let's do it on the S&P 500 index itself. Well, once again, we've got put call parity. Once again, we've got the same economics as owning the S&P 500, be it a mutual fund or the 500 stocks. But now these options are 1256 contracts. And because they're 1256 contracts, any gain or loss on both the call and the put are going to be treated as 60% long-term, 40% short-term. At year end, we've got to recognize our gains and losses. Once again, interest expense and dividends are considered in the pricing of the options. So once again, we're going to economically earn the dividends. We're economically incurring the interest expense, but not for tax purposes. For tax purposes, everything is 60-40. And so this comes up with an obvious tax planning opportunity. If I think that the S&P 500 is either going to go up or go down, and over the next 3-month period, if I buy the options on the mutual fund index, all my gains and losses are going to be short-term because it's 3 months. If I instead do the options on the S&P 500 index, all my gains and losses are going to be 60% long-term and 40% short-term. So to me, that's an obvious planning opportunity. If our investment horizon is very short, it's very short-term, less than 1 year, and you're planning to make money, use the options on the S&P 500 index. Don't use the options on the mutual fund, and don't buy the stocks directly because you're going to get out of them in 3 months. Everything's going to be short-term. So this is just an obvious tax planning idea, using getting the same economics, using different instruments, getting different tax results. And then the last thing I want to talk about with stocks is we enter into a forward contract to buy the S&P 500. So we're entering into a contract today to buy the S&P 500 a year and a half from now, and we'll set the price today. By the way, the price that we set under the forward contract is going to be equivalent to the put call parity price. That's another beauty of understanding put call parity. So if we go back to our example with Xilinx, the put call parity price for Xilinx was the strike price, 200 times $120,000, plus the cost for buying the options. So your put call parity price, look at that, is equal to $20,050. That would have been the price of buying the shares and paying the interest expense. And that's exactly how we price a forward contract. You take today's price, you add to it the cost of carrying that position, which with stock would be interest expense. And then if there were dividends, you would then have to subtract the dividends, because the person, while the forward contract is outstanding, the person who has the exposure to the stock won't be getting the dividends. So they're going to subtract the dividends from the forward price. That's what makes the doing my example with a dividend paying stock a little more complicated. All right, but now we enter into a forward contract. Well, for tax purposes, there's no gain or loss recognized until the forward contract is closed. And once again, if we sell out of our forward contract, then we're going to have a gain or loss with respect to the forward contract, and that's going to be long-term or short-term, depending on the holding period of the forward contract. If we actually take delivery of the underlying property, that's a non-taxable event. So there's no gain or loss recognized. We now own the underlying property. Our basis equals whatever the price was under the forward contract. And our holding period of stock probably begins on the day that we receive delivery. There are some people who think you can add on the holding period of the forward stock to the forward contract to the stock. I think that's the minority view. The majority view is that you don't include the holding period of the forward. But once again, interest expense and dividends are considered in the forward price, but they're not explicitly stated. So for tax purposes, there is no dividend income. There is no interest expense. Now, the only place where there might be dividend income is when we talked over swaps. And if we talked about swaps, and if we have a person in a foreign country entering into a forward contract to buy the S&P 500, and it's a Delta One instrument, then we could have dividends solely for purposes of withholding purposes, All right, so all these things start coming together. But now we've gone over 4 different ways to buy stocks. You could buy the stocks directly. You could enter into options on the stocks, or enter into options on an S&P mutual fund or an S&P ETF. That gives you another set of tax results. We can enter into options on the index, and because they're 1256 contracts, they're going to give us different tax results. And then finally, we can enter into a forward contract to buy the S&P 500, and that will give us different tax results as well. So now we've got 4 different ways to buy the S&P 500 and end up with 4 different tax results. And again, one might not be necessarily better than the other all the time. So what you want to do is decide, based on your specific facts and circumstances, which one of these 4 things gives you the most advantageous result. Now we get to something that I think is extremely interesting, and that is we can actually invest in debt synthetically. And we do that by buying stock, selling a call, and buying a put with identical strike prices and expiration dates. And once again, is this all based upon put-call parity? And now we use the second formula on that algebraic page. Short call plus long put equals short position. And we go back now, we say long stock plus short stock equals no economic exposure to the stock. So let's just show that on the whiteboard. Right, and I'm going to use my favorite stock. We'll use Xilinx again. And so I buy 1,000 shares of Xilinx at $200 per share. Excuse me. And I'm out $200,000. And I don't NUI, I BUI. And so for those of you who obviously seen this course or taken my other course, you know that I'm not a great typist. And so we short 1,000 shares of Xilinx at 200. And that brings in, that brings in $200,000. And when we bought it, we laid out $200,000. So net, it's $0. And if Xilinx goes up, so Xilinx goes up to 225 on our long position, 225 on our long, we're plus $25,000. On our short, we're minus $25,000. And we haven't done anything. And if Xilinx goes to 175, on our long, we're down $25,000. And on our short, we make $25,000. So this is just one big nothing. We're out no money. If Xilinx goes up, we make no money. If Xilinx goes down, we make no money. That all makes sense. So now instead what I'm going to do is I'm going to buy Xilinx. 1,000 shares. I'm going to lay out $200,000. And what I'm going to do is I'm going to sell a call, buy put, $200 strike price. And 1 year to maturity. And what's going to end up happening is I'm going to receive approximately $2,000. But now look at what's happened. I've laid out $200,000. And I've taken in $2,000. So I'm out of pocket $198,000. And again, I've sold a call and I bought a put. So what's going to happen at maturity? So at maturity, Xilinx is greater than $200. What's going to happen is the call will be exercised. And I will sell Xilinx. I will sell my shares, sell Xilinx. And I'm going to receive $200,000. Now at maturity, Xilinx is less than $200. Well, now what's going to happen, let's just be consistent. So now it's less than 200. So what am I going to do? I'm going to exercise the put. When I exercise the put, what am I doing? I'm selling my shares. I sell Xilinx. I'm going to receive $200,000. So no matter what Xilinx is trading at, whether it's above 200 or below 200, one of the options is going to be exercised. And either way, I'm selling it. If it's at 200, you have to close everything out. You're going to have to buy back the call. You're going to have to buy back the call, sell the put. Hopefully that will come out to zero, and then sell your stock for $200,000. But putting aside Xilinx being exactly at $200 at maturity, one of the options is going to be exercised. So your initial outlay was $198,000, and your sale is going to be $200,000, and your gain is going to be $2,000. And that's going to happen no matter what. So you're just investing $198,000 to make $2,000. Your rate of return is approximately 1%. What your rate of return is going to always equal, it would be very close. Rate of return will be very close to U.S. Treasury obligation of similar length. And the market is extremely efficient. This is going to happen no matter what stock you use. It's going to happen economically. So if T-bills going out for the amount of time that your trade is going out are yielding 1.5%, you're going to get 1.5% on this transaction. And if it's 75 basis points, you're going to get 75 basis points. But you're not investing in a treasury bill, but you're doing this investment. And by the way, these are all going to be done with listed options. You're going to use flex options because you want them to be European style. When you long this, they don't have to be European style because you're not worried about early exercise. But remember, European style option means it can only be exercised at maturity. And when we do things with tax planning, we always want to, and we're using options, we like them to be European style. But there are these flex options traded on the exchange, they're listed, and they can be set up to be European style. The beauty of doing an exchange traded option is that the exchange is backed by every major bank and brokerage firm in the US. So for your options to not be honored, it means that every bank and every brokerage firm in the US is out of business, which means I don't think we even care anymore that we're not getting paid. So this is a AAA credit instrument. You really have no economic risk with respect to the underlying stock, and you have very little, if any, credit risk. Because if every bank and every brokerage firm has gone under or can't make good on this, I think the US government would step in, assuming we still have a US government if that happened. All right, so there is no economic risk on this transaction. What we now have is an options transaction and stock transaction that's earning interest income. And it's not interest. It's not interest for tax purposes. So what is it for tax purposes? Let's go back to the PowerPoint. Hopefully this brings us back to the PowerPoint. Yes. So what happens for tax purposes? We're going to end up with a mixture of non-qualified dividends. If we're doing it on a stock, we're going to end up with dividend income, and it's not going to be qualified because we're going to own a put. We're going to have ordinary income and short-term gain or loss. The reason we have ordinary income is because you're earning an interest equivalent and you're doing it with capital assets. There's a code section 1059, and it converts what would otherwise be capital gain into ordinary income. And what it tells you to do is take the applicable federal rate under section 1274 for your time period, multiply that by 120%, and whatever that comes out to, that amount of income is ordinary income. If you have excess income, that will be capital gain. And because we're doing puts and calls on a stock, or we're going to be in a straddle, we're not going to get holding period. It's all going to be short term. So that's what happens from a tax point of view. Another way of investing in debt is to buy a call and sell a put on a stock or stock index, and buy a call and sell a call and buy a put on the same stock or stock index as an A. And we manipulate the strike prices so a cash outflow is created if we're going to make an investment. And so the puts and calls are going to have identical strike prices in A. The puts and calls are going to have identical strike prices in B. And the strike prices in A and B are going to differ, but the expiration dates are going to be identical. So position A is establishing a long position. Position B is establishing a short position. So once again, we have no economic exposure. But if we manipulate the strike prices, we can create either a cash inflow or a cash outflow. So let me do an example, and I'll do a cash inflow. And then after we do that, if we reverse the number, we'll be creating a cash outflow. And instead of investing in debt, we're actually going to be creating debt. So again, I think this is extremely interesting, or from a tax viewpoint, becomes very interesting. And you could do a lot of tax planning with this. So let's see how this works. And let's go through the economics first, because this one's a little harder to follow the economics. We just got more things going on. So what we're going to do is we're going to buy a call with a strike price of 190. And we're going to sell a put with a strike price of 190. And buying a call, selling a put is a synthetic long position. So now what we're going to do is we're going to sell a call with a strike price of 200. And we're going to buy a put with a strike price of 200. All of these options are going to have the same expiration date, but as you can see, we've got different strike prices. But the second transaction is a short position, and the underlying property is the same. So in the first position, we're long. In the second position, we're short. Economically, we have no risk, but because we set up different strike prices, this transaction will either cost $9, I'm going to make up $9, or we're going to take in, or we're going to receive $9. And it's just going to depend on which side of the transaction you're on, and which options you're buying, and which options you're selling. But you're either going to have an upfront cost of $9, or you're going to, on day one, you're going to take in $9. And now what happens? The underlying, let me do it on over here. Underlying goes to 220. Well, if the underlying goes to 220, on our first transaction, the call that we bought call is now worth $30. It's now worth 30, right? The exercise price is 190. The underlying goes to 220. The call is worth $30. The put that we sold, the sold put, is worth 0. No one's going to put it to us at 190 when the underlying goes to 220. So the net position is worth $30. The second position, we sold a call at 200. The stock, the underlying is now 220. That call is worth minus 20. We have a problem on that call. We've got something. We have a liability of $20. The put that we bought, the bought put, is worth 0. Right? We're not going to exercise our put and take in $200, and we can sell the property for 220. So this is worth minus 20. When we combine the two positions together are worth $10. So when the underlying property goes up, when we combine all 4 of those options, their net worth is $10. Now what I want to do is I want to see what happens when the underlying goes down. Underlying goes to 170. Well, now our bought call is worthless. We have a call with a strike price of 190. The underlying went to 170. It's worthless. What about our sold put? We sold the put with a strike price of 190, and the underlying goes to 170. We have a problem. We are down $20. it can be put to us at 190 and the underlying is 170. Our sold put has a loss of $20 in this. So our total worth of this position is minus 20. But what about our second position? We sold the call. The call that we sold is worthless. We sold the call with a strike price of 200. The underlying is 170. This is worthless. But what about the put that we bought? That's going to save us. The put that we bought is worth $30. We can put the underlying property to somebody for 200. It's the property's only worth 170. This is worth $30. So combined, our worth is $10. So no matter which way this goes, at maturity, it's going to be worth $10. If we initially paid for this, so if we had a cost of $9, and at the end it's worth $10, we have a profit of $1. And once again, that profit is locked in. That's interest income. It's as though we bought a bond. So this is another way of buying a bond. If we receive $9 on day one, because we do the exact opposite transaction, and it's going to be worth $10 at the end, we're going to lose $1. And I'm going to go into slightly more detail in a couple of minutes. But when you structure this transaction and you're receiving the money, you can set up in such a way that you actually have access to that money and you can pull it out of your account. Well, if you've pulled the money out of your account, you've pulled out $9 on day one, and at maturity, you're going to have to pay back $10. What have you done? You've borrowed money. That $1 is the equivalent of interest expense, but it's not going to be treated as interest expense for tax purposes. This is a transaction in puts and calls. That $1 loss is going to end up being a capital loss. And I think that this one is really the more interesting one. This is where I think you can really do some really good tax planning for client. All right, so let's go back to the PowerPoint. So now that we've gone through the economics of this transaction and show you that it's another way to either invest in debt or take out debt. So again, now we're investing in debt by doing this with options on stock or stock indexes. So what are the tax results? The entire gain is going to be short-term capital gain. Why? Because it's a straddle. It's the underlying property is stock, and we have short-term capital gains. Once again, though, because we're investing, we have that same thing about the 120% of the applicable federal rate. We're going to turn it into ordinary income, and only the excess are going to be treated as capital. If we do a put and a call on an index, the gains are recognized at year end. Once again, we have to do that 120% of the AFR rate, and that's going to turn that portion of the capital into ordinary. But any excess, if there is excess, is going to be treated as 60% long-term and 40% short-term. You're going to do that at year end. You're also going to do that when the transaction ends. But all of a sudden, there's no interest income anywhere. Everything is capital or ordinary. So it's, again, it's just a very different tax result. Now we can create that. So as I showed you, we can structure the puts and call, the price strike prices so that we actually take in money on day one. So what you've done is you've created cash. If you have enough other securities in your account to show the dealer that when this thing comes due for $10, you have enough other securities that you'll be able to satisfy that $10 obligation, they'll let you take out the cash. You can do with it whatever is that you want. So what that means is you've borrowed $9. So what ends up happening? You end up with a loss. But because it's a loss, if we do this in stock or as options on a stock, it's all going to be a short-term capital loss. If we do this on an index so that we're dealing with 1256 contracts, then the loss could be 60% long-term, 40% short-term, and it'll be marked to market at year end. But what's interesting, what I think is very interesting about this transaction is if you have a client that's borrowing money for personal uses, the interest expense on that debt is non-deductible. So if they're borrowing money to buy an airplane, they're borrowing money to buy a yacht, they're just borrowing money for personal uses, all of that interest expense is non-deductible. If they do this transaction instead, they're going to end up with a capital loss. And if they have capital gains, they can offset the capital gains with that capital loss. All of a sudden, you've created, you've turned a non-deductible interest expense into a deductible capital loss. Also, it might, many times, the borrowing rate on this transaction will actually be less than the rate of interest they're paying on their personal debt. So not only are you giving them a better tax result, you might also be reducing the interest expense that they're paying. In any event, this is, you know, if you're just reducing the interest rate, that's great. And if they can use their capital losses, then it's a double win. It's just a win-win. You've created a non-deductible expense and made it deductible, and you've actually lowered their cost to borrow money. So to me, this creating the debt is actually, I think, more exciting and can create more benefit for your clients than investing in debt. But you could do either one. And then finally, I want to talk about buying gold. Gold is something we haven't talked about in this class, but I'm going to talk about 5 different ways to buy gold. We could buy physical gold. We can buy in an ETF that only holds gold, and the symbol for that on the New York Stock Exchange is GLD. There's a trust that only holds gold, and it's called the Sprott Physical Gold Trust, and that actually trades in Toronto in Canada. We could buy listed call and sell a listed put on gold, or we could enter into a futures contract to buy gold. And then finally, we can buy an over-the-counter call and sell an over-the-counter listed option on gold, or enter into a forward contract to buy gold. So there are going to be 5 different ways to buy gold, and we're going to end up with 5 different tax results. So what we haven't talked about is how is physical gold treated from a tax-free point. When you buy physical gold, the short-term gains are taxed at 37%, just like any other short-term gains. But long-term gains are taxed at 28%. Gold is deemed to be a collectible. And for whatever reason, Congress decided that when you have long-term gains on collectibles, which physical gold is considered, you pay tax at a 28% tax rate. So if we're going to buy physical gold, we're going to pay a tax rate of 28%. Instead, we could buy a publicly traded gold ETF. And you might think to yourself, oh, that sounds like it's a stock. It's traded on the New York Stock Exchange. It looks like a stock. It acts like a stock. And stock is not treated as a collectible. Doesn't matter what the underlying property is of the corporation. If it's stock, then long-term capital gains would be 20%. There's only one problem. And by the way, this comes up all the time. When you buy, if you buy options on an ETF, the thing you always have to look at is what is the ETF for tax purposes? Because if the ETF is a corporation, the options are taxed under 1234. If the ETF is a trust or a partnership, they're taxed under 1256. Now, I haven't gotten to the option slide yet, so I'm jumping ahead, but we're buying this gold ETF. As it turns out, the gold ETF that trades on the New York Stock Exchange is treated as a grantor trust for tax purposes. And because it's treated as a grantor trust for tax purposes, you're not deemed to own stock. You're not deemed to own an entity. You're deemed to own the underlying property. And the underlying property in this case is gold. We're right back to as though we bought the underlying gold. Any gains and losses on GLD will be taxed at 28%. So, okay, so if we buy physical gold, we're taxed at 28%. If we buy the gold ETF, we buy GLD, all our gains and losses are going to be taxed at 28% because it's a grantor trust. So now we go to the next investment, the Sprott Physical Gold Trust. And you might say to yourself, wait a second, I'm not going to buy a trust. I just learned that if I buy a trust, it's as though I own the underlying gold, and I'm going to have to pay tax at 28%. The problem is the symbol for the Sprott Physical Gold Trust is PHYS. And for tax purposes, even though the name of the company is Sprott Physical Gold Trust, it's treated as a corporation for tax purposes. So that's the good news. Now I'm buying stock in a corporation. The bad news is that the corporation is located in Canada. So for US tax purposes, and I guess you've learned this with Professor Cohen, is that it's treated as a PFIC. So I call it a PFIC, other people call it a PIFIC. Whatever you call it, it's a passive foreign investment company. And if I don't make any tax elections, when I sell the Sprott Trust and I have a profit, the tax rate I'm going to actually pay is 37%. And to the extent that I've held it for a number of years, they're also going to impute an interest charge. So it's going to become a terrible way to buy gold. However, if I make a qualified electing fund election, a QEF election, as I said, I hope you've learned this with Professor Cohen. If not, you've got to look this up. But if you make a QEF election, because the trust doesn't sell any gold during the year, it just has an X number of ounces of gold that it bought. It never changes those number of ounces. And all transactions in the stock are done on the exchange, and they're not done with the trust itself. So the number of shares outstanding never changes. The number of ounces of gold that it's holding never changes. Just the value of the stock changes based on the value of the gold, which means that all gains on your disposition are going to be treated as long-term capital gains. When you make this QEF election, you say, okay, to the extent the underlying entity has income during the year, I'll pick up that income and pay tax on it currently. The beauty about the Sprott Physical Gold Trust is it has no income during the year. There's never any tax to pay while you're holding it. You only pay tax when you sell it, and it's going to be subject to long-term capital gains rates. You are going to get the 20% rate. This ends up being the best way for a US investor who wants to be a long-term investor in gold to buy their gold. The problem with it is the price of the Sprott Physical Gold Trust trades at, sometimes it trades at a discount to the price of the gold it's holding. Sometimes it trades at a premium. And you never know when you're buying it, what you're going to get out at. You might have bought it when it was trading at a premium, and when you get out, it's going to be trading at a discount. Or it might be great, or you might have bought it at a discount, and then when you want to get out, it's even trading at a bigger discount. It would be great if you bought it at a discount, and then when you got out, it was selling at a premium. But tax-wise, this gives you the best tax results, but you must make the QEF election. If you don't make the QEF election, it's going to give you the worst tax results. Okay, we could buy a listed call and sell a listed put on gold, or enter into a futures contract to buy gold. All of those contracts, everything that I've talked about, there are 1256 contracts. If they're 1256 contracts, we know that everything's going to be 60% long-term, 40% short-term. We are going to have to mark to market at year end, so that's going to be different. And their gains, in effect, are going to be taxed at an effective rate of 26.8%. So it's a little less than the 28%. And how do we get that? 40% to 37% plus 60% at 20% gets us to 26.8. So you could do this and you lower your tax rate by 1.2%. If you actually take delivery under the futures or under the options, as we know when we went over 1256 contracts, that's going to be a taxable event. And if we do take delivery, our holding period in the gold starts all over again. All right, but this is another way to take a position in gold and get a different tax result. We could buy an OTC call and an OTC listed option, or enter into a forward contract. None of these are 1256 contracts. These are going to be options covered under Section 1234, or a forward contract, which is just going to be treated as a capital asset. We only recognize gain or loss when we get out of the transaction. There's no year-end recognition event. Either it's all long-term or it's short-term. Again, if we're selling a put, then we're going to have short-term gains on our puts. So we're going to buy an OTC call and sell a listed put on the gold in order to come up with our put call parity and put us in the same position as being in gold. Taking delivery in either event will not be a taxable event. So if we exercise our option or the short put is exercised against us, we're not going to be recognizing a taxable event. If we take delivery under the forward contract, we're not going to recognize a taxable event. When we exercise the call and we take delivery under the option, or if the put is exercised and we're assigned, the holding period in the gold starts on the delivery date. If we take delivery under the forward contract, again, I think the better answer is that it starts on delivery date when we take delivery under the forward contract as well. So now we've come up with different ways to invest in stocks, different ways to either buy debt or issue debt using options, or finding all these different ways to buy gold, right? So we've talked about 5 different ways to buy gold with 5 different tax results. Although the ETF on gold and buying physical gold end up being almost identical, but again, we end up with different ways to do it. And this one, we're going to end up with the same tax results. But the other 3 all give us different tax results. So once again, these are the types of things that I want you all to think about. Are there different ways to do the same? Are there different ways to do the same thing economically and end up with different tax results? And I think when you start applying these rules in that way is where you can add a lot of value to your clients. Now, there's not going to be any homework assignment on what we did today. And there's not going to be something on the final exam that relates directly to this lecture, but there will be things on the final exam that relate to the things that we talked about today, because 1250, because straddle rules are going to be on the exam, debt instruments will be on the exam. But again, I think this is what the whole purpose of this course is really all about. Ways for you to think differently, ways for you to say, wow, there are these things that we can do that create similar economics, give us different tax results. And once again, that's where I think all of you can add a lot of value to your clients. So I hope you've enjoyed the course and good luck.